In this video from SuperfastCPA, we're going to cover leases, how to classify leases. So first, when you're looking at a problem, you want to know if you are dealing with the accounting side for the lessee or the lessor. So the lessee, of course, is the party using the equipment and making payments to basically rent the equipment. Although with these finance lease types, sales type, or direct financing lease, really a sale is taking place. But the three types for the lessee would be you could have a short-term lease, an operating lease, or a finance lease. And then on the lessor's side, you'll either have an operating lease, a sales type lease, or a direct financing lease. So on the lessee side, a short-term lease is any lease that's less than 12 months, and as long as there's no agreement in place where the title transfers to the lessee at the end of the lease, because then that would be a sale and would need to be accounted for that way. If it's just basically a rental agreement and it's less than 12 months, the lessee debits lease expense and credits cash or accounts payable as the monthly payments are made. The operating lease, the lessee is going to record a right of use asset and then a lease liability account on the balance sheet. The lease expense, it's a single line item as an operating expense on the income statement, and the lease expense is composed of interest plus the amortization of the right of use asset. But again, it's presented just as one line as an operating expense. With a finance lease, the lessee will also record a right of use asset and a lease liability account. Interest and amortization expense are presented separately on the income statement. So in a different video, we'll go through the actual accounting for the leases, the lease payments, the right of use asset, the amortization, all those things. The lessor, on the lessor side, for an operating lease, the lessor is going to keep the asset on their balance sheet and it continues to be depreciated. Lease revenue and depreciation expense are presented on a gross basis in the income statement. For a sales type lease, the asset is derecognized on the balance sheet. Then they would take the net investment in the lease and record that. The net investment account, really what that is the sum of the minimum lease payments, the sum of the present value of the minimum lease payments. The net investment account is increased by interest income and decreased by payments collected. Selling profit or loss is recorded at the commencement of the lease. That's the differentiator between this sales type lease and the direct financing lease. Interest income is based on the effective rate of interest for the lease. Now for the direct financing lease, it mostly works the same. The asset is derecognized on the balance sheet, and then there's a net investment in the lease that's recorded. The net investment account is increased by interest income and decreased by the payments collected. And again, this is where it's different. The selling profit is deferred, and any selling loss is recorded at the commencement of the lease. Interest income is based on the effective rate of interest in the lease. So now we'll go into some example problems for how you would classify a lease. So this first one, Swift Inc. entered into a 5-year lease with Taylor Inc. The lease does not transfer ownership at the end of the lease term, and it includes a purchase option which is not reasonably expected to be exercised by Swift. The leased asset has a 10-year economic life, no residual value. The present value of the annual lease payments are equal to 80% of the asset's fair value. If the asset has no alternative use to Taylor at the end of the lease, how should Swift classify the lease? Would it be classified as a sales type lease, an operating lease, a short-term lease, or a finance lease? Now, if you want, you can pause the video and look through this, make your decision, and then we will go into the solution right now. So the answer to this is a finance lease. Now, if we come back, we're of course talking on the lessee side of things. So it's a finance lease. Okay, so why is it a finance lease? Here's the explanation. First of all, Swift is the lessee in this case, and Taylor is the lessor. If the lease is longer than 1 year, then we know it's going to be at least, or we know it's going to be either a finance lease or an operating lease. So there are 5 criterion when you're evaluating a lease. If it meets one of the 5 criteria, then it is a finance lease, and if it doesn't meet any of the 5 criteria, then it would be an operating lease for the lessee. So the 5 criteria: does the lease transfer ownership of the asset to the lessee? No, it does not. Does the lease contain a purchase option which is reasonably expected to be exercised by the lessee? We saw that the purchase option is included, but it's not reasonably expected to be exercised, so no. Is the lease term 75% of the asset's useful life? No, it's 5 out of 10. Is the present value of the lease payments at least 90% of the asset's fair market value? No, we know that that is 80% of the asset's fair value. So we're all no's so far. Is the asset of such a specialized nature that it has no alternative use to the lessor after the lease? Yes. The asset has no alternative use to Taylor, so how should Swift classify the lease? That is what gives us 1 yes. That's all we need. So this is a finance lease. Swift will classify this lease as a finance lease. A few other points. Again, if it didn't meet any of the 5 criteria, then it would be classified as an operating lease. A sales type lease is what the lessor would classify the lease as long as it met one of the 5 criteria. Again, a short-term lease is any lease that's 12 months or less. So now we will just change the facts a little bit, and we will do a problem that deals with the lessor's side of things. So the facts are the same. Swift entered into a 5-year lease with Taylor, 10-year economic life, a present value of the annual lease payments equal to 80% of the asset's fair value. This part's different. The present value of the annual lease payments plus the guaranteed residual value equals the fair market value of the underlying asset. If it is probable that Taylor will collect the lease payments and the guaranteed residual value, how should Taylor classify the lease? Would it be a sales type lease, an operating lease, a direct financing lease, or a finance lease? So the answer is a direct financing lease. The explanation. Again, Swift is the lessee, Taylor is the lessor. In this case, none of the 5 criteria are met. But for the lessor, there are 2 more considerations that you have to look at before you just classify this as an operating lease. So the original 5, those don't apply. For the lessor only, you then look at, does the present value of the lease payments plus any guaranteed residual value equal or exceed the fair value of the asset? And then the second one is it probable that the lessor will collect the payments, meaning all the lease payments, and the guaranteed residual value at the end of the lease term? If both of those are true, then the lessor has a direct financing lease. Now again, if none of these apply, if none of the 5 are true, and then either one of these is not true, then it is a operating lease for the lessor. So that's the distinction. So at this point, let's look at this hopefully easy to understand guide to classifying a lease. So on this side, we have the lessee, we have the main 5 criteria right here, and then you have the lessor's side that deals with everything in green. Lessee, everything in red, the main 5 criteria for the difference between an operating lease or a sales type lease, which to a lessee is a finance lease. So on the lessee's side, is it a yes to any of the 1 through 5? Does ownership transfer? Is the purchase option likely to be exercised? Lease term being greater than 75% of the economic life of the asset? Are the lease payments totaling greater than or equal to 90% of the asset's fair value, and is the asset so specialized in nature that it is of no use to the lessor after the lease. If it's a yes to any of those five, the lessee has a finance lease. If it's a no to all five, then it is a operating lease. If the lease term is less than 12 months and there's nothing about the transfer of ownership of the asset, then it's just simply a short-term lease. Now on the lessor side, again, if it's a yes to any of 1 through 5, then you have a sales type lease for the lessor, whereas the lessee again would have a finance lease. If it's a no to all 5, then you come down here for 6 and 7. Again, only for the lessor. Do the lease payments, the total of the lease payments plus the guaranteed residual value, is that greater than or equal to the fair value of the asset? If that's a yes, you come to number 7. Is it likely that the lessor will collect everything, meaning all the lease payments and the residual value? If those are both a yes, then the lessor has a direct financing lease. This is pretty rare, okay? Those do exist, and you could see this on the test, but the direct financing lease is pretty rare. So it's either, normally it's going to be yes to one of these 5, which gives you a sales type lease, or if it's no to all 7, where if it's not yes to any one of these 5, it will usually be no to all 7, which would give you an operating lease, whereas both the lessee and the lessor have an operating lease. But this number 6 and number 7, it does exist only for the lessor, so you do have to consider those two things. So that is the guide to classifying a lease based on the criteria. We'll do one more example problem. Dimple entered into an agreement to lease an ice cream mixer from Smile for 10 months for $100 per month. The fair value of the mixer is $800 and its useful life is 24 months. How should Dimple classify the lease? Would that be an operating lease, short-term lease, a direct financing lease, or a finance lease? So hopefully you know where this is going. Entered into an agreement for 10 months. That is the key piece of information. There's nothing mentioned about the title or the ownership changing hands at the end of the lease. So this is a short-term lease. The lease period is less than 12 months. This is a short-term lease. The accounting is very simple. Dimple would debit lease expense and credit cash or accounts payable each month for the $100 payment. And then on Smile's side, they would just be debiting cash and crediting lease revenue for $100 each month. And if you'd like more help with your CPA process, you can get our free guide that will help you start the process and avoid making very costly mistakes. It's called the Busy Candidate's Guide to Passing the CPA Exams Fast. This is tailored towards how to fit in enough study time each day, even if you're extremely busy and working full-time. You can get it at superfastcpa.com/free, or just text FAST CPA to 44222. I would also invite you to subscribe to our YouTube channel, press the little bell thing so that you're notified, because we are beginning to publish a lot of these type of videos on YouTube so that you stay updated with those. Thank you for watching, and we'll talk soon.